Every chart tells you exactly what's about to happen. This candle cluster, that's dying momentum. This volume spike, that's clear confirmation. What about this level? This is a strong reversal zone. You just need to know what to look for. I call it the candle framework. 6 elements that work on any chart, any market, any time frame. Let's go. Most traders get destroyed because of one mistake. They zoom into a 5-minute chart. They see a perfect setup and they take the trade, and the market immediately crushes them. Then they blame the indicator, they blame the strategy, they blame the market. But the market didn't trick them, they tricked themselves. Let me show you what they missed. Here's you on a 5-minute chart. You see a massive green candle, a breakout. Looks clean and strong. Your brain says buy, so you click. Now watch this. I zoom out to the 1-hour chart. That rocket you just bought, it's slamming directly into a brick wall. Massive resistance level. Sellers are waiting right there. Now I zoom out to the daily. The whole trend is down. That perfect breakout on the 5-minute, it was a trap. A tiny bounce inside a massive crash. 3 charts, same asset, same moment. 3 completely different stories. The 5-minute trader thinks it's a buy. The daily trader knows it's a short. Here's the uncomfortable truth. You're not just reading a chart. You're trading inside someone else's position. And if you don't know which time frame controls the game, you're not the trader. You're the liquidity. So how do you stop being the sucker? You use 3 time frames every time. First, the higher time frame. It tells you the direction of the market, and you don't fight against it. If the daily chart is crashing, I don't care how pretty your 5-minute buy signal looks. Don't take it. Second, the trading time frame. This is where you find the setup, the pattern, the structure. Third, the lower time frame. This is your trigger. This is where you get surgical. You are not looking for setups here. You're timing the exact moment to enter. So the higher time frame tells you direction. The trading time frame tells you setup. Trigger tells you entry. Skip any of these and you're trading blind. But even if you nail the time frames, there's another trap. Markets only do 3 things. They trend, they range, or they transition. In a trend, you follow the flow. You buy pullbacks, and you don't fight the momentum. In a range, you flip it. Buy the lower levels and sell the upper ones. Breakout strategies fail here. And then there's the transition, the danger zone. The market is tightening. It's not trending yet. It's not ranging anymore. It's deciding. Most traders get destroyed here. They use a trend strategy in a choppy market, or a range strategy right before the breakout. 80% of trading losses come from using the wrong playbook for the wrong phase. Before you look at a single candle, ask this: what phase is this market in? That's your edge before the trade even starts. Now you know the context. You know which time frame controls the game and what phase you're in. But where exactly are you standing on this battlefield? We talk about this next. Now the vertical axis is price. The horizontal axis is time. You think you understand them. You don't. Let's start with price. Those numbers on the right side of your screen. They're not just levels, they're psychology. Look at a chart at all-time highs. Everyone who owns this asset is in profit. There's no pain, no bag holders waiting to dump. That's why all-time highs often explode higher. Pure greed, with no resistance. Now look at a chart deep in a pullback. Some people are in profit, but many are trapped. They bought at the top, they're underwater. They're praying for price to come back so they can sell and escape. That's called overhead supply. Translation: there are desperate sellers waiting above you. You're not reading price levels, You're reading the pain of trapped traders. Now look at time. Most traders ignore it. They just look at the shape. But time tells you how strong a level is. Picture this. Price sits at one level for several weeks. Thousands of trades happen there. Buyers and sellers build massive positions. That creates a thick layer of memory. Now picture price spiking through a level and leaving instantly. Almost no one traded there. No memory. Which level matters more? The 3-week zone. The longer price stays somewhere, the harder it is to break later. And then there's Whitespace. Look at the gaps where price moved fast. Big candles with no overlap. I call this thin air. Whitespace above price. That's room to run. No resistance memory. When price enters that zone, it moves fast because no one's waiting to sell. Whitespace below price. That's an air pocket. If price falls into that zone, there's no support. Before you look for a trade, find the white space. You want to trade through thin air, not into thick traffic. Now you know where you're standing, but you need to understand the soldiers fighting around you. This is where most traders waste years. They memorize Japanese names, shooting stars, dojis, haramis. Honestly, throw them away. I'm going to teach you how to read the story instead. Every candle is a fight between buyers and sellers. That's it. First, the body. A big body means one side dominated. A small body means nobody won. Indecision. Second, the wicks. A wick isn't just a line. It's a failed attempt, a rejection. Long upper wick. Buyers try to push higher. Sellers slap them down. That wick is a monument to buyer failure. Long lower wick. Sellers tried to crash the price. Buyers stepped in and absorbed everything. Seller failure. Third, the close. The close tells you who had the final word. Even if there's a long wick, if the candle closes near the high, buyers won. I don't need to know the pattern's name. If I see a small body with a massive lower wick, I know the story. Sellers attacked, they failed, and buyers took control. That's bullish. But here's the thing. Single candles often lie. You need to read clusters, groups of 3 to 5 candles. Watch a cluster moving up. Are the bodies getting smaller? Are the upper wicks getting longer? If yes, the story is changing. Buyers are tired. They're running out of ammo. Even if price is still rising, the strength is dying. Now watch a pullback. If the red candles are getting smaller with long lower wicks, sellers are exhausted. A reversal might coming. So don't read the word, a single candle. Read the full sentence of candles. Now, a candle story is just a claim. You need to know if it's true. For that, you need a lie detector. Dynamics are the hidden engine of every chart. Volume and momentum. Most traders ignore them. They see price moving up and assume it's real. But price can be manipulated. Volume can't. Think of it this way. Price is the claim. Volume is the verification. Watch this breakout. Price smashes through resistance, looks beautiful. Now check the volume. If the volume is weak, that breakout is a trap. The smart money isn't participating. It's just a few retail traders chasing. Low volume breakouts fail almost every time. Now watch a breakout with a massive volume spike. That's institutional money. That's real participation. That breakout holds. Trust price, but verify with volume, always. Now watch for divergence. This is the early warning system that saves your account. Price is making higher highs, but volume is making lower highs. Think about it. Price is climbing, but fewer people are buying. The party is getting more expensive, but the guests are leaving. This trend is running on fumes. I've avoided thousands of bad trades by seeing this. The chart looks bullish, but the volume is screaming, nobody believes this. When price and volume disagree, trust the volume. Now watch momentum. Fast momentum is emotional. It burns hot and reverses fast. Slow, grinding momentum is calculated. It tends to last. But watch for the shift. If an uptrend starts flattening, if it takes more time to cover less distance, momentum is dying. When momentum flattens and volume drops, get out. Okay, you have context, axis, narratives, and dynamics. Now the question, where do you actually click the button? Support and resistance. This is where chart reading becomes predictive. But listen closely. Levels aren't lines on a screen. Levels are memories. Why does price bounce at a specific number? Because humans remember pain. Look here, price reverses at this level. Everyone remembers that. The sellers who sold there made money. The buyers who bought there lost money. When price comes back to that level, the memory triggers action. Sellers want to defend their win. Losers want to escape at break-even. That collective psychology creates the wall. But most traders draw 50 lines and get confused. Real levels have three things: multiple touches, not just one. Then clear, sharp reactions. Price bounced hard, not just drifted through. And volume spikes at the touch. Proof that people cared. If a level doesn't have these, delete it. It's just noise. Now here's the most reliable setup in trading. The flip. Support becomes resistance. Resistance becomes support. Check this out. Price bounces on this level 3 times. Strong support. Buyers feel safe there. Then price crashes through. Now all those buyers are trapped. When price rallies back to the underside of that old support, what happens? All those trapped buyers sell to escape. That selling pressure turns old support into new resistance. The flip works because of human nature. If you only learn one setup from this entire video, learn the flip. Wait for a level to break. Wait for price to come back and test it from the other side. Enter there. Highest probability entry in the game. Now let's put it all together. Separately, these are just concepts. Together, they're an edge. I'm looking at this chart. Buy or sell. Let's run the framework. First, context. I check the daily. We're in an uptrend. I'm only looking for buys. I'm not shorting this. Axis. Where are we? Price is pulling back into a Whitespace area. There's room to move. Levels. We're approaching a key level that used to be resistance. I'm looking for a flip to support. Narratives. Price hits the level, but I don't buy yet. I wait for the candles to speak. I see a cluster of small red candles, then a strong green candle that closes near the high. Buyers have stepped in. Then dynamics. Did volume spike on that green candle? Yes, institutions are buying this level. Everything aligns. This is a high probability trade. Now compare that to a trap. Context is bullish, but price is hitting resistance. Bad location. The candles are green, but the upper wicks are longer, so buyers are struggling, and volume is dropping. A rookie buys because it's going up. A pro stays in cash because the candle framework says it's a possible trap. This is the complete framework. Context sets the game. Axis reveals the psychology. Narratives show the battle. Dynamics confirm the truth. Levels predict the reaction. Edges when they all align. If you implement this system for 30 days, your brain will rewire, and you will see only the best opportunities. Now, this analysis framework is only a part of the equation. To see the full picture and really make this work, you need to watch the next video. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for.